Look, I need you to pay attention to what I'm about to show you, because what's happening in the gold market right now is something most people over 50 are completely missing. And I'm not talking about some theoretical future scenario. I'm talking about movements happening this week that could fundamentally change how your retirement savings perform over the next 12 to 24 months. Let me start with something that happened just 72 hours ago that barely made the news. The People's Bank of China reported their gold reserves increased for the 18th consecutive month. Now you might think, okay, China's buying gold, so what? But here's what they're not telling you in the headlines. When you dig into the actual tonnage numbers and cross-reference them with import data from Switzerland and London, there's a massive discrepancy. China is reporting they added about 10 tons, but the physical flows suggest they're accumulating closer to 50 to 70 tons per month. Why would they underreport? Because they don't want to spook the market before they've finished positioning themselves. And China's not alone. The Reserve Bank of India just announced they're accelerating their gold purchases. Poland's central bank governor went on record last month saying they want gold to represent 20% of their reserves, up from 11%. Turkey, Singapore, the Czech Republic, they're all moving in the same direction. In 2023, central banks bought over 1,000 tons of gold. That's the second highest annual purchase on record. But here's the kicker. In the first half of this year alone, they've already surpassed 800 tons. We're on track for potentially 1,500 to 1,600 tons of central bank buying this year. Now, why does this matter to you specifically if you're over 50 with a retirement plan? Because central banks don't speculate, they don't chase trends, they position for structural shifts in the global monetary system. And when you see this kind of coordinated accumulation across dozens of countries, they're telling you something. They're preparing for a world where the dollar's role as the dominant reserve currency is diminishing, not disappearing overnight, but gradually losing its stranglehold on global trade and finance. Let me paint you a picture of what this looks like in practice. Saudi Arabia just let their 50-year petrodollar agreement with the United States expire in June. For 5 decades, oil was priced exclusively in dollars. If you wanted to buy oil, you needed dollars. That created automatic demand for U.S. currency and treasury bonds. That agreement is now gone. Saudi Arabia is now accepting yuan, euros, and even discussing gold-backed trade arrangements. The UAE is doing the same thing. Russia and India are settling trade in rupees and rubles. Brazil and China are trading in their own currencies, bypassing the dollar entirely. What does this have to do with gold? Everything. Because when countries move away from dollar-denominated trade, they need something else to settle imbalances and store value. And historically, for thousands of years, that something has been gold. It's the only asset that's universally recognized, has no counterparty risk, and can't be printed into oblivion by any single government. Now let's talk about what's happening with price. Gold hit an all-time high of $2,685 per ounce in September. Then it pulled back to around $2,600. Most mainstream analysts said, oh, the rally's over, gold's topping out. But look at what happened next. It consolidated for exactly 3 weeks, building a base, and then exploded through 2,700, then 2,750. As I'm recording this, we're trading above $2,760. But here's what's fascinating. This move is happening with almost no retail participation. The average investor isn't buying gold right now. Jewelry demand in India is actually down because prices are too high. Chinese retail demand has softened. So who's driving this? Institutions? Sovereign wealth funds? Family offices? The smart money that manages billions and thinks in decades, not quarters. They're accumulating quietly, systematically, without making noise. And when you see price moving higher on institutional accumulation rather than retail mania, that's actually the healthiest kind of bull market, because retail comes in at the end. We're not at the end. We're in the middle innings. Let me show you something about market structure that most people don't understand. The gold market operates on 2 levels, paper and physical. Paper gold includes futures contracts, ETFs, and derivatives. Physical gold is the actual metal, bars, and coins sitting in vaults. For years, the paper market has been 100 to 200 times larger than the physical market, meaning for every ounce of physical gold, there are 100 to 200 paper claims on that same ounce. This works fine as long as everyone doesn't ask for delivery at the same time. But something's changing. Physical demand is surging while paper supply is tightening. The COMEX, which is the major futures exchange in New York, has seen its registered gold inventory, the gold available for delivery, drop by 40% over the past 18 months. We're now sitting at around 400,000 ounces of registered gold. Meanwhile, open interest, The number of contracts that could demand delivery represents over 40 million ounces. That's a 100-to-1 ratio. If even 2% of contract holders demanded physical delivery, the exchange would be in serious trouble. And we're starting to see stress fractures. In March, there was a brief moment where the spread between London spot prices and COMEX futures widened to $70 per ounce. That's massive. It means physical gold in London was trading at a significant premium to paper gold in New York. Why? Because there's a shortage of physical metal in the right locations. Gold is heavy and expensive to move. You can't just teleport it from a vault in Switzerland to New York overnight. And when you have central banks in Asia buying aggressively, that gold is flowing east and not coming back. Now, let me tell you a story that illustrates what happens when paper markets collide with physical reality. In 1980, the Hunt brothers tried to corner the silver market. They accumulated massive positions in silver futures and started taking delivery of physical metal. The exchanges panicked and changed the rules mid-game, limiting how much silver could be bought and forcing liquidation. The Hunts lost billions. But here's the lesson. They were individuals trying to manipulate a market. What's happening now is different. You have sovereign nations, central banks with unlimited fiat currency, systematically accumulating gold. They're not trying to corner the market. They're trying to protect themselves from the debasement of fiat currencies. And you can't change the rules on a central bank the way you can on private speculators. Quick aside here, because this is relevant if you're sitting on $100,000 or more in retirement accounts. I put together a free guide on how gold IRAs actually work. It's in the description below. It covers how you can get physical gold into your retirement account without triggering tax penalties or early withdrawal fees. If that's something you've been curious about but didn't know where to start, it's worth checking out. No pressure, just information if it's relevant to your situation. Anyway, back to where this price is headed and why the next 12 months could be critical. Let's talk about the Federal Reserve and interest rates, because this is where most people get confused. The conventional wisdom is that gold performs poorly when interest rates are high, because gold doesn't pay interest or dividends. So why would you hold gold when you can get 5% in a money market fund? That logic makes sense on the surface, but it ignores something crucial: real interest rates. Real interest rates are nominal rates minus inflation. If you're getting 5% in a savings account but inflation is running at 4%, your real return is only 1%. And if inflation is actually higher than reported, which many people believe it is, when you factor in food, energy, insurance, and housing costs, your real return might be zero or even negative. Gold tends to perform best when real interest rates are low or negative, because in that environment, you're losing purchasing power by holding cash, even if you're earning interest. Right now, the Fed has rates at 5.25% to 5.5%. Inflation, according to official CPI numbers, is around 3.7%, so real rates are positive, around 1.5% to 2%. That should be negative for gold, right? But gold's at all-time highs. Why? Because the market is forward-looking. Traders and institutions are pricing in what they think happens next. And what happens next is the Fed starts cutting rates. They've already signaled they're done hiking. The next move is down. When rates start coming down, but inflation remains sticky, real rates compress. And that's rocket fuel for gold. But there's another factor that's even more important than interest rates: fiscal policy. The U.S. government is running a deficit of over $2 trillion per year. The national debt just crossed $35 trillion. Interest payments on that debt are now over $1 trillion annually, more than we spend on defense. Think about that. We're paying more just to service our debt than we spend on the entire military. And as rates have gone up, those interest payments have exploded. When the government issued debt at 1% or 2%, it was manageable. Now they're rolling over maturing bonds at 4% to 5%. The math doesn't work. So what are the options? You can raise taxes, but there's a limit to how much you can extract from the economy without causing a recession. You can cut spending, but politically that's almost impossible. Social Security, Medicare, defense, and interest payments make up over 80% of the budget. Everything else, education, infrastructure, veterans benefits, is less than 20%. You can't balance the budget by cutting discretionary spending. The only real option left is to inflate the debt away, print more money, devalue the currency, and make the debt smaller in real terms. And that's exactly what every major economy is doing. The US, Europe, Japan, China, they're all running massive deficits and expanding their money supplies. The European Central Bank's balance sheet is still bloated from years of quantitative easing. The Bank of Japan is still buying government bonds to keep yields suppressed. China is injecting liquidity to prop up their real estate sector and banking system. This is a global phenomenon. And when every major currency is being debased simultaneously, there's no safe fiat currency to hide in. The dollar might be the cleanest dirty shirt, but it's still dirty. This is why gold is moving. It's not about fear or panic. It's about rational actors looking at the fiscal and monetary trajectory of major economies and concluding that hard assets, assets that can't be printed or debased, are going to outperform paper assets over the next decade. And if you're over 50, you don't have 30 or 40 years to recover from a major currency devaluation or a bond market collapse. You need to protect what you've built now. Let me give you a historical parallel that's eerily similar to today. In the 1970s, the U.S. was running large deficits from the Vietnam War and Great Society programs. Inflation was rising. The dollar was under pressure. In 1971, Nixon closed the gold window, ending the Bretton Woods system where foreign governments could exchange dollars for gold at $35 per ounce. That was the moment the dollar became a pure fiat currency, backed by nothing but trust in the U.S. government. What happened next? Gold went from $35 in 1971 to $850 in 1980. That's a 24 times increase in 9 years. But it didn't go straight up. It rallied to $200 by 1974, then crashed back to $100 in 1976. Everyone said the gold bull market was over. Then it exploded from $100 in 1976 to $850 in 1980. The people who bought in 1976 when everyone else was bearish made 8.5 times their money in 4 years. Now, I'm not saying we're going to see gold at $20,000 or $30,000 in the next few years, but I am saying the structural conditions today, massive deficits, currency debasement, geopolitical fragmentation, are similar to the 1970s, and if gold follows even a fraction of that trajectory, we could be looking at $3,500 to $5,000 over the next 3 to 5 years. And for someone in their 50s or 60s, that kind of move in a portion of your portfolio could make a significant difference in your retirement security. Let's talk about what's happening with mining supply, because this is another piece of the puzzle most people ignore. Gold production peaked in 2018 at around 3,300 tons per year. Since then, it's been flat to declining. Why? Because the easy gold has already been mined. The large, high-grade deposits that could be extracted cheaply are mostly gone. What's left are lower-grade deposits that are deeper, harder to access, and more expensive to mine. The average grade of gold ore has been declining for decades. In the 1970s, you could mine ore with 10 grams of gold per ton and make money. Today, many mines are processing ore with 1 to 2 grams per ton. That means you have to move 10 times as much rock to get the same amount of gold. And it's not just about grade. It takes 10 to 15 years to bring a new gold mine online from discovery to production. You have to find the deposit, drill it out, do feasibility studies, get permits, build infrastructure, and then start mining. And with environmental regulations getting stricter, permitting is taking longer and costing more. So even if gold prices go higher and incentivize more exploration, there's a massive lag before new supply comes online. Meanwhile, demand is accelerating. Central banks are buying 1,000 plus tons per year. Jewelry demand, especially in Asia, remains strong despite high prices. And now you're starting to see institutional investors, pension funds, endowments, sovereign wealth funds allocate to gold as a strategic asset. If demand is rising and supply is flat to declining, what happens to price? It goes up. This is basic economics. But here's where it gets interesting for retirees specifically. Most people in their 50s and 60s have the bulk of their wealth in stocks and bonds, maybe some real estate. That's the traditional 60-40 portfolio. 60% stocks, 40% bonds. That portfolio worked great for the past 40 years because we were in a disinflationary environment. Interest rates went from 15% in the early 1980s down to near zero by 2020. When rates fall, bond prices rise. So you made money on both stocks and bonds. It was the greatest bull market in financial history. But that era is over. We're now in a reflationary, potentially stagflationary environment. Inflation is structurally higher due to deglobalization, aging demographics, underinvestment in commodities, and massive fiscal spending. And when inflation is high, bonds perform poorly because the fixed income they pay loses purchasing power. Stocks can perform okay if companies can pass on higher costs, but valuations get compressed because future earnings are worth less in today's dollars. Gold, on the other hand, thrives in this environment. It's a real asset that maintains purchasing power during inflation. It's negatively correlated to bonds, meaning when bonds go down, gold often goes up. And it provides diversification in a portfolio that's otherwise heavily exposed to financial assets. A 5% to 10% allocation to gold can significantly reduce portfolio volatility and improve risk-adjusted returns, especially during periods of financial stress. And we're entering a period where financial stress is likely. The stock market is trading at valuations near historic highs. The Shiller P/E ratio, which smooths out earnings over 10 years, is above 30. The only times it's been higher were 1929 and 2000, right before major crashes. Now, that doesn't mean a crash is imminent. Markets can stay overvalued for years, but it does mean the risk-reward is skewed to the downside. If you're 55 or 60 years old, do you really want to be fully invested in stocks at these valuations? Or does it make sense to take some chips off the table and put them into an asset that's negatively correlated and has its own fundamental drivers? Let me tell you about something that happened in 2008 that most people forget. When the financial crisis hit, everything sold off initially. Stocks, bonds, commodities, real estate, everything. Gold dropped from $1,000 to $700 in a matter of weeks. People said, see, gold's not a safe haven, it crashed too. But then something interesting happened. While stocks continued to struggle and took years to recover, gold bottomed in October 2008 and then rallied from $700 to $1,900 by 2011. It tripled in less than 3 years while the S&P 500 was still trying to get back to its 2007 highs. Why did that happen? Because the response to the financial crisis was massive monetary and fiscal stimulus. The Fed dropped rates to zero, launched quantitative easing, and expanded its balance sheet from $800 billion to $4.5 trillion. The government ran trillion-dollar deficits, and gold, being a hedge against currency debasement, went parabolic. The people who bought gold in late 2008, when everyone else was panicking and selling, made enormous returns. Now we're in a similar setup. The Fed's balance sheet is still over $7 trillion, down from $9 trillion but still massively elevated. Government deficits are over $2 trillion per year in a supposedly strong economy. What happens when the next recession hits? They're going to do the same thing they did in 2008, but bigger. More rate cuts, more QE, more fiscal spending. And gold is going to respond the same way it did then. But the move could be even larger because the starting point for debt and deficits is so much higher. There's also a geopolitical dimension to this that's critical. The world is fragmenting into blocks. You have the US and its allies on one side, China, Russia, and their partners on the other, and a large group of non-aligned countries in the middle trying to navigate between the two. The BRICS nations, Brazil, Russia, India, China, South Africa, are actively working on alternatives to the dollar-dominated financial system. They're discussing a BRICS currency, potentially backed by a basket of commodities including gold. They're building payment systems that bypass SWIFT. They're settling trade in local currencies. Now, will they succeed in creating a viable alternative to the dollar? Maybe, maybe not. The dollar has enormous advantages: deep, liquid markets, rule of law, military power backing it. But even if they only partially succeed, even if they just create more optionality for countries to trade outside the dollar system, that reduces demand for dollars and treasuries. And when demand for treasuries falls, yields rise, which makes the US debt problem worse, which forces more money printing, which drives more countries away from the dollar. It's a self-reinforcing cycle. And in that world, gold becomes the neutral reserve asset. It's not controlled by any single country. It's not subject to sanctions or freezes. Russia learned this lesson the hard way when the US and Europe froze $300 billion of their foreign exchange reserves after the Ukraine invasion. You think China didn't notice that? You think Saudi Arabia, the UAE, and other countries with large dollar reserves didn't take note? They're all thinking, if we get on the wrong side of US foreign policy, our reserves could be frozen. Gold can't be frozen. It's physical, it's in your vault, and no one can take it away with the stroke of a pen. This is why central banks are buying. It's not about making a profit. It's about having an asset that's outside the Western financial system that can't be sanctioned, and that holds value regardless of what happens to the dollar or euro. And when central banks are buying at $2,700 per ounce, they're telling you they think it's going higher. Because central banks don't buy at the top. They have decades-long time horizons and access to the best research and analysis in the world. Now let's talk about what this means practically for someone over 50. You've spent 30 or 40 years building wealth. You've saved, invested, maybe paid off your house. You're looking at retirement in 5, 10, 15 years. The last thing you want is to see your purchasing power eroded by inflation or your portfolio cut in half by a market crash right when you need to start drawing on it. This is called sequence of returns risk. If you retire and the market drops 30% in your first few years of retirement, you're selling assets at depressed prices to fund your living expenses, and you may never recover. Gold provides a buffer against that risk. It's not correlated to stocks, so when stocks drop, gold often holds steady or even rises. It protects against inflation, so your purchasing power is maintained. And it's liquid, you can sell it quickly if you need cash. It's not a speculation, it's insurance. And just like you wouldn't cancel your homeowner's insurance because your house hasn't burned down, you shouldn't avoid gold just because we haven't had a major currency crisis yet. The question isn't whether you should have some exposure to gold. The question is how much and in what form. Some people buy physical coins in bars and store them at home or in a safe deposit box. That gives you direct ownership and control. Others prefer gold ETFs, which are easier to buy and sell but involve counterparty risk. And then there's the option of holding gold within a retirement account, which has tax advantages but requires setting up a self-directed IRA with a custodian who allows precious metals. Each approach has trade-offs. Physical gold is the most secure but the least convenient. ETFs are convenient, but you don't own the actual metal. Gold IRAs give you tax benefits but involve more paperwork and fees. The right choice depends on your situation, your comfort level with different structures, and how much you want to allocate. But the key is to make a decision and take action, because the window where gold is still under $3,000 may not be open for long. Let me give you one more data point that's flying under the radar. The gold to silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, is currently around 84-1. Historically, that ratio averages around 60-1. When the ratio is above 80, it means silver is cheap relative to gold, and when gold starts a major bull run, silver typically outperforms on a percentage basis because it's more volatile and has industrial demand on top of monetary demand. In the 2009 to 2011 gold rally, silver went from $10 to $48, nearly a 5 times move, while gold went from $800 to $1,900, about 2.4 times. If we're in the early stages of a similar move, silver could offer even more upside, though with more volatility. But the core holding should be gold. It's the anchor, the stable store of value that's been recognized for 5,000 years. Silver is more speculative, more industrial, more volatile. For someone over 50 focused on wealth preservation, gold is the primary play, with maybe a smaller allocation to silver if you want more upside potential and can handle the volatility. Here's the bottom line. The gold market is telling you something right now. It's at all-time highs despite rising interest rates, despite a strong dollar, despite no retail participation. It's being driven by central banks, institutions, and sovereign wealth funds, who are positioning for a world where fiat currencies are worth less and hard assets are worth more. The fiscal and monetary trajectory of major economies is unsustainable. Deficits are exploding, debt is compounding, and the only way out is inflation. And in that environment, gold is not just an investment, it's a necessity. If you're over 50 with a retirement plan, you need to be paying attention to this, not next year, not when gold hits $3,000 or $3,500, but now, because the best time to buy insurance is before you need it, and the best time to position for a major shift in the monetary system is before everyone else figures it out. The smart money is already moving. The question is, are you going to move with them? Or are you going to wait until it's obvious to everyone and the price has already doubled?